Disclaimer.
Yeah.
This analysis is for entertainment purposes only. Consult a professional for your specific case.
Absolutely. Always do your own research.
Right. So welcome to today's deep dive. Our mission today is to really construct a start-to-finish investment thesis on ServiceNow.
Ticker symbol NOW.
Ticker NOW, exactly. Pulling from all these financial sources, analyst reports, and those massive announcements from their Knowledge 2025 event.
Knowledge 2025 was huge.
It really was. But to start off, we kind of have to address the elephant in the room, because there is a glaring contradiction right now with this company.
Yeah, the stock chart.
The stock chart is terrifying. If you look at it right now, the technical radar is just screaming Category 5 hurricane.
It's pretty brutal.
I mean, according to Charles Schwab's Morning Movers, the stock has formed this classic bearish head and shoulders pattern right here in March 2026.
Which technical traders hate.
Oh, they despise it. The stock is down 23% year to date. It's just stuck trading in this frustrating like $113.62 to $114.88 range.
Yeah.
So if you're a pure technical trader, you are probably grabbing a parachute right now.
Right, you're bailing out.
But then you look out the window at the fundamental reality of the business, and you see a company operating at the absolute bleeding edge of the AI revolution.
They're completely redefining enterprise software.
Exactly. I mean, just to give you all a sense of how transformative this tech is, we are talking about a company whose own CEO recently went on CNBC and casually predicted a 30% unemployment rate for college grads.
Just casually dropping that bombshell.
Right. Because of the AI automation they are building.
Yeah.
So we need to understand if this 23% drop is a warning sign or a massive buying opportunity.
Yeah, and to figure that out, we first have to understand exactly what ServiceNow is actually building and really who they are disrupting.
Okay, so let's start with the business landscape. Because I feel like a lot of people have this outdated mental model of what ServiceNow does.
Oh, for sure.
Historically, they were kind of the digital plumbers of the corporate world. Right?
That's a great way to put it. Digital plumbers.
Yeah, like you use their software as a service model to automate IT workflows. If a server crashed or you spilled coffee on your laptop, ServiceNow was the ticketing platform.
Right. They logged the problem, routed it to an IT guy, and made sure the pipes kept flowing.
They were the ultimate system of record.
Exactly. They logged the work so that humans could go do the work. But if you look at the highlights from Knowledge 2025, that whole system of record era, it's officially over.
Completely over.
They are executing this massive pivot into becoming a system of action.
A system of action.
Yeah. They are calling themselves an AI control tower for the entire enterprise.
Okay, so here's where it gets really interesting for me. Because AI control tower sounds like, pure corporate marketing jargon.
Oh, it definitely does.
What does that actually mean mechanically? How does a ticketing system become a control tower?
Well, it comes down to the difference between generative AI and agentic AI.
Okay.
Generative AI, like your standard chatbot, it waits for you to ask it a question, and then it generates some text.
Right, it's reactive.
Exactly. But agentic AI doesn't wait. It observes, it reasons, and it acts autonomously. So at Knowledge 2025, they rolled out the ServiceNow AI platform, which runs on this new architecture they call the AI Agent Fabric.
So wait, instead of just generating an email about a broken server, it actually goes and fixes the server.
Precisely. Let's say a database starts bottlenecking. In the old days, ServiceNow creates a high-priority ticket, alerts an engineer, the engineer logs in, clears the cache, and closes the ticket.
The classic workflow.
Right. But under the AI Agent Fabric, an autonomous AI agent notices the bottleneck itself. It uses a high-performance reasoning model to diagnose the root cause.
Okay.
Then it securely logs into the database, clears the cache, verifies the performance is back to normal, and just logs a report that it handled it.
So the human engineer never even gets a notification.
Never even knows it happened. And to power this level of reasoning, ServiceNow partnered with NVIDIA to build this custom model called April Nematron 15B.
April Nematron 15B. So a 15 billion parameter model just for enterprise workflows.
Exactly. They don't need a massive trillion parameter model that writes poetry, right? They just need a hyper-focused model trained on how corporate IT, HR, and customer service interact.
I mean, I see the vision, but here's where I have to push back a little. ServiceNow used to be the digital plumber, like we said. Now they're trying to be the general contractor for the entire business.
That's the goal.
But they announced ServiceNow CRM at that event, unifying sales and order management, Aren't they walking directly into Salesforce's backyard with that?
Oh, they are kicking the fence down.
Right. I mean, is it really wise to pick a street fight with the CRM king right when your stock is down 23%?
It is an incredibly aggressive move, and honestly, your skepticism is exactly what the market is pricing in right now. But this software collision course with Salesforce is fascinating because Salesforce owns the customer data, right? The customer 360 view.
Right, they know who bought what.
Exactly. But ServiceNow wants to own the enterprise 360 view. They want to own the operational reality of how that product is actually delivered and serviced. And Salesforce isn't just sitting still either.
No, Salesforce is pushing back.
Yeah, Salesforce just launched Agentforce to push directly into IT service management. So Salesforce is moving into IT, and ServiceNow is moving into sales.
They're just crashing into each other in the middle.
Exactly. And ServiceNow realized that to win this enterprise-wide war, they couldn't just build everything internally. They had to buy their way into a bigger moat.
Which brings us to their massive acquisition spree over 2024 and 2025. And this is another area where I have a question, because spending $7.75 billion on Armis in December 2025,
It's a huge bet.
it's a staggering amount of money. ServiceNow is a cloud software company. Armis secures physical IoT and operational technology,
Yeah.
like MRI machines, factory robots, HVAC systems. Are they buying these companies just because their organic growth is slowing? Or is monitoring hospital equipment really a necessary puzzle piece for this autonomous IT vision?
It sounds like mission creep until you think about agentic AI.
Uh-huh.
If you are promising a hospital that your AI control tower will run operations autonomously, your AI cannot be blind to the physical world.
Because, I mean, you can't optimize a hospital if you don't even know if the MRI machine is plugged in.
Exactly. Let's say a factory cooling system goes offline. If ServiceNow's AI agent is going to fix that, it needs to talk to the physical sensors. That's what Armis does. It gives ServiceNow an endpoint advantage that Salesforce just doesn't have.
Okay, the hardware visibility makes sense. But they also bought Visa for identity security, right?
Yep.
And MoveWorks for conversational agentic AI. And Data.World for data cataloging.
Yeah, when you piece it all together, they are basically buying the individual organs to build a complete autonomous worker.
What?
MoveWorks gives it conversational intelligence. Armis gives it physical visibility. Visa makes sure the AI agent actually has the security permissions to reboot a machine without going rogue.
Right, so it doesn't accidentally shut down the whole factory.
Exactly. And Data.World ensures the AI is using clean corporate data. So they are taking on legacy IT consulting giants like Accenture, Cognizant, and Leidos, but replacing human consultants with a swarm of AI agents.
Okay, let's unpack this. Because the ambition is clearly huge. But how is the market actually pricing this growth?
Well, the math gets a bit dizzying.
It does. I mean, at around $114 a share, their PE ratio is sitting at 68.7.
Yeah, 68.7 times earnings, which is steep.
Insanely steep. If we look at the U.S. software industry average, it's what, 27.8?
27.8 exactly.
And their peer average is only 45.7. Simply. Walson even estimates a fair PE of 41.7.
And we also have to look at their own historical baseline. I mean, if you compare their current PE to their 5-year average, ServiceNow has historically traded at a premium, sure, because of their growth.
Right.
But when the broader market gets shaky, maintaining a multiple that's so disconnected from the industry average is really tough to justify on the surface.
It's like looking at the price per square foot of a house compared to the neighborhood.
Oh, that's a good analogy.
If the neighborhood average is 27 and then now is at 68, they are the most expensive house on the block by a mile.
Yeah.
But multiples only look at the present, right?
Mm-hmm.
How do we factor in their future growth? Because they are growing.
They are an absolute machine. Despite that high PE, their underlying health is incredible. They have a 77.5% gross margin.
Wow.
Their 3-year revenue compound annual growth rate, or CAGR, is 21.2%.
Over 21%.
Yeah. And GuruFocus projects their fiscal year 2026 subscription revenue to hit between $15.53 billion and $15.57 billion.
And they have a pristine balance sheet, too. A debt-to-equity ratio of just 0.19.
Which is how they can casually drop $7.75 billion on Armis without destroying their company.
Right. But, okay, to truly value a high-growth, cash-generating machine like this, we have to look past those relative multiples, don't we?
We do. We need an absolute valuation method. We need to run a 10-year discounted cash flow analysis. a DCF.
Okay, so let's walk through the math on this 10-year DCF, because we need a baseline first.
Right. For the base, we are using their current free cash flow, which aligns with an earnings base of roughly $1.75 billion.
1.75 billion. Got it. And what growth expectation are we applying to that?
We want to be really conservative here, so we are applying just a 9% growth expectation for operating earnings over the next 10 years.
Wait, really? Only 9%, but they've been growing at 21% historically.
Exactly. We are essentially stress testing the model. We want to see if the stock is still a buy, even if their growth gets cut by more than half.
Okay, I like that margin of safety. So we grow the 1.75 billion by 9% for 10 years. What about the terminal value?
For the terminal value, we use a very standard, conservative 2.5% terminal growth rate, just assuming they eventually mature and grow with global inflation.
Makes sense. And the discount rate to bring all those future dollars back to today.
We apply a 10% discount rate.
Okay, so what does this all mean? We run the numbers, 1.75 billion base, 9% growth, 2.5 terminal, discounted at 10%. What is the actual calculated intrinsic value?
The model spits out an intrinsic value of $165.31 per share.
$165.31.
Yeah.
And the stock is currently trading around 114.
Right. So even when we sandbag the growth down to 9%, the math shows the stock is trading at roughly a 30.5% discount to its intrinsic value.
So the market is just completely mispricing their long-term cash generation because of that short-term chart pattern panic.
Exactly. The technical traders are fleeing, but the fundamental math is solid.
Well, let's see if the professionals agree with this. What is the current analyst sentiment looking like?
Wall Street is very much on board. Out of 53 analysts covering the stock, 41 rated a buy.
41?
Yeah, 3 rated a hold, and only 1 rates it a sell, and the median price target is $182.50.
Which is even higher than our conservative DCF value.
Much higher. And I want to highlight BNP Paribas here. They just upgraded Now W to outperform with a near-term target of $140.
Oh, nice. What was their rationale for the upgrade?
They are citing expectations of 20% subscriber organic revenue growth by the end of fiscal 2026, mostly driven by strong adoption of their Pro Plus tier, which is where they monetize a lot of this agentic AI stuff.
Right, the premium features. So bringing it all together, we have the business landscape shift to agentic AI, the massive acquisitions to build an AI moat, a pristine balance sheet, and a deeply discounted DCF valuation. What is our final verdict?
Our final verdict is a definitive BUY.
A BUY.
Absolutely. At the current price of around $114, you are getting roughly a 30.5% discount to that intrinsic value of $165. Despite the high PE ratio and the bearish head and shoulders pattern, the long-term fundamentals are just incredibly strong.
I am right there with you. It is a resounding BUY. I was skeptical about the Armis acquisition, but seeing how it builds the physical endpoint for autonomous AI makes perfect sense. The AI acquisitions and that 0.19 debt-to-equity ratio really protect the downside.
Right.
And that $165 intrinsic value highlights the massive upside.
But if we connect this to the bigger picture, it does bring up a rather intense macro issue.
The job market impact.
Exactly. I mean, we mentioned Bill McDermott's quote from CNBC earlier, the CEO of ServiceNow himself warning that AI agents could easily send college grad unemployment over 30% in the next few years.
Because businesses will just reduce entry-level hiring to cut costs.
Because the AI agent fabric will just do the work autonomously.
Which leaves us with a really profound question to mull over. If our buy thesis is correct, and ServiceNow successfully automates the enterprise with AI agents, what happens to the broader economy?
It's a huge unknown.
We might be looking at a highly profitable company, but one whose very success could fundamentally alter the white-collar job market and consumer spending forever.
Yeah, it's a structural shift in how businesses operate.
Definitely. Well, we'll leave you to think on that one. Thank you all for joining us on this deep dive. Remember to keep questioning the numbers and always look for the aha moments hidden in the data.
Catch you next time.